The system was never announced as a transfer mechanism, yet its outcomes consistently move wealth in one direction over time. This contradiction sits at the center of modern finance, where growth and inequality expand together. Economic systems are often described as neutral frameworks for exchange, but their design determines who benefits most from expansion. When credit becomes the primary driver of growth, those closest to its creation gain a structural advantage. At the core of this pattern is the relationship between debt and money creation. In modern economies, most money enters circulation as debt issued by banks and governments. This means every unit of currency begins its life with an obligation attached to it. Over time, the need to service that obligation reshapes entire economies around repayment and expansion. When debt expands faster than real economic output, imbalances begin to form beneath the surface. These imbalances are not immediately visible, but they accumulate pressure within the system. Central banks attempt to manage this pressure by adjusting interest rates and liquidity conditions. However, these tools often delay consequences rather than eliminate underlying risks. As credit expands, asset prices tend to rise faster than wages. This creates a widening gap between those who own assets and those who rely on income alone. The system rewards leverage, allowing those with access to capital to multiply their holdings. Meanwhile, those without access remain tied to slower forms of economic participation. This is not a coincidence, but a recurring pattern observed across multiple financial cycles. It reflects the structural incentives embedded within credit-based economies. To understand this pattern, it is necessary to look at historical precedents. One of the clearest examples can be found in early 20th century Germany. In 1919, following World War I, Germany faced massive reparations under the Treaty of Versailles. The government turned to money creation to meet these obligations, expanding the money supply rapidly. By 1923, the German market collapsed, with inflation reaching astronomical levels. Prices doubled in days, and savings accumulated over decades became effectively worthless. Those holding physical assets or foreign currency were able to preserve their wealth. In contrast, wage earners and savers saw their purchasing power disappear almost entirely. This event demonstrates how currency devaluation can act as a transfer mechanism. Wealth shifts away from those holding cash toward those holding tangible or inflation-resistant assets. A similar pattern emerged during the Great Depression in the United States. In 1933, the government devalued the dollar by raising the official price of gold from $20.67 to $35 per ounce. This policy effectively reduced the real value of debt while increasing the nominal value of assets tied to gold. It redistributed wealth in a way that stabilized the financial system but altered ownership structures. During this period, banking reforms such as the Glass-Steagall Act were introduced. These measures aimed to separate speculative activities from traditional banking functions. Despite these reforms, the underlying reliance on credit expansion remained intact. Economic recovery was driven by renewed borrowing and government spending. In the post-World War II era, a new global monetary system was established under the Bretton Woods Agreement in 1944. This system tied currencies to the US dollar, which was convertible to gold. For several decades, this arrangement provided relative stability. However, growing fiscal deficits and international imbalances began to strain the system. By 1971, the United States suspended gold convertibility, effectively ending the Bretton Woods system. This marked the transition to a fully fiat currency system. Without a gold constraint, governments gained greater flexibility to expand the money supply. This also increased the potential for inflation and long-term currency depreciation. Throughout the 1970s, inflation surged in many advanced economies. In the United States, inflation reached over 13% in 1979. This period eroded real wages and savings while benefiting borrowers who repaid debt with devalued currency. It reinforced the pattern of wealth shifting through monetary policy. Central banks responded by raising interest rates aggressively. In 1980, the Federal Reserve increased rates above 15% to control inflation. While this stabilized prices, it also triggered a recession. The cycle of expansion and contraction continued, driven by credit dynamics. In the decades that followed, financial markets became increasingly central to economic growth. Deregulation and innovation expanded access to credit across sectors. Households, corporations, and governments all increased their reliance on borrowing. This created a system highly sensitive to interest rates and liquidity conditions. By the early 2000s, housing markets in several countries experienced rapid price increases. Low interest rates and relaxed lending standards fueled this expansion. In 2008, the global financial crisis exposed the fragility of this system. Mortgage-backed securities collapsed and major financial institutions faced insolvency. Governments and central banks intervened with unprecedented measures. Trillions of dollars were injected into the financial system to prevent collapse. These interventions stabilized markets but had long-term consequences. Asset prices recovered quickly while wage growth remained subdued. This divergence intensified wealth inequality. Those with investments benefited from rising markets, while others struggled with stagnant incomes. The use of quantitative easing became a defining feature of post-crisis policy. Central banks purchased government bonds and other assets to lower interest rates. This increased liquidity and supported financial markets. However, it also reinforced the connection between policy decisions and asset valuations. As a result, financial markets became more dependent on central bank actions. This created a feedback loop between policy and market behavior. In the 2010s, global debt levels reached historic highs. According to the Institute of International Finance, total global debt exceeded $250 trillion by 2019. This level of indebtedness required continued low interest rates to remain sustainable. Any significant increase in rates risked triggering widespread defaults. The COVID-19 pandemic in 2020 accelerated these trends. Governments implemented massive fiscal stimulus programs funded by increased borrowing. Central banks expanded their balance sheets at unprecedented rates. This further increased the supply of money in the global economy. By 2021 and 2022, inflation began rising sharply in many countries. Supply chain disruptions and strong demand contributed to price increases. In the United States, inflation reached over 9% in mid-2022. This was the highest level in 4 decades. Central banks responded by raising interest rates again. This marked a shift from expansion to tightening in monetary policy. Higher rates increased borrowing costs across the economy. This placed pressure on households, businesses, and governments alike. At the same time, asset markets experienced increased volatility. The relationship between liquidity and valuations became more apparent. Those with diversified assets were better positioned to navigate these changes. Others faced greater financial uncertainty. The pattern remains consistent across different time periods. Credit expansion leads to asset inflation, followed by correction or devaluation. This cycle redistributes wealth in ways that are often misunderstood. It operates through mechanisms that appear technical but have real social consequences. Modern financial systems rely heavily on confidence. Trust in currency and institutions is essential for stability. When that confidence weakens, the effects can spread throughout across markets. Currency values, interest rates, and asset prices all respond to shifting expectations. Reserve currency status plays a significant role in this dynamic. The US dollar has held this position since the mid-20th century. This status allows the United States to borrow at lower costs. It also increases global demand for dollar-denominated assets. However, reserve status is not permanent. Historical examples show that dominant currencies eventually face challenges. The British pound, for instance, lost its reserve status in the 20th century. This transition reflected changes in economic and geopolitical power. Today, discussions on alternative reserve assets are becoming more common. These include other currencies and even digital assets. While no immediate replacement exists, gradual shifts are possible. These changes can alter the flow of capital globally. If the current system continues expanding debt at its current pace, pressures will increase. Managing these pressures will require difficult policy choices. Inflation, austerity, or restructuring are typical outcomes of excessive debt. Each option involves some form of wealth redistribution. Inflation reduces the real value of money. Austerity reduces public spending and can impact living standards. Debt restructuring can shift losses onto creditors. In each case, the system adjusts through reallocation. Understanding this process is essential for interpreting economic signals. It provides context for policy decisions and market movements. The system is not static, but constantly evolving. However, its core mechanisms remain consistent. Credit creation, interest rates, and asset valuation form the foundation. These elements interact in predictable ways over time. Recognizing patterns does not eliminate risk. It allows for better preparation and more informed decisions. Individuals and institutions respond differently to these conditions. Access to information and resources plays a critical role. Those who understand the system can position themselves more effectively. Others may experience its effects without fully recognizing the cause. This asymmetry contributes to long-term disparities. It reinforces the perception that outcomes are unevenly distributed. The system was not necessarily designed with malicious intent. It evolved through policy decisions, crises, and adaptations. However, its structure produces consistent results. Wealth tends to concentrate where access to capital is greatest. This is not a temporary anomaly, but a recurring feature. It reflects the incentives embedded within financial systems. Over time, these incentives shape behavior at every level. Governments, institutions, and individuals all respond to them. The result is a cycle that continues across generations. Each phase builds on the previous one. Understanding this cycle provides a different perspective on economic events. It shifts focus from isolated incidents to underlying patterns. The question is not whether the system transfers wealth. The evidence suggests that it does, repeatedly. The more important question is how and why it happens. Answering this requires examining both policy and structure. When viewed through this lens, economic history becomes more coherent. Events that seem disconnected reveal a common thread. This thread is the interaction between debt, money, and power. It defines the trajectory of modern economies. As the system continues to evolve, these dynamics will remain relevant. They will shape the outcomes of future crises and recoveries. The final insight is not a prediction, but a reframing. The system's design influences outcomes more than most realize. Recognizing this does not change the system immediately. It changes how it is understood, which is the first step toward navigating it.